hope this isn't too blurred. I grabbed this as a screenshot from our online trading platform that our administration team work in all day. And in case you've been wondering, you know, exactly how does a share fluctuate and how does it occur that we see prices move up and down the way we do? Essentially, you've got two sides of the fence. You've got a seller, a potential seller, and you've got a potential purchaser. Now, if there's a great piece of news that comes out on the economy or on, say, China, and we've got BHP here as an example, you've got the listed price, as we can see here, is $33.39, and on the other side of the scale, we've got the sell price here at $33.40. So what happens is essentially you've got someone on the buy side that's willing to pay $33.39 for a company, and you've got someone on the other side that wants to sell it for $33.40. Now the key is the share price is actually $33.39, but the key is for someone who is someone's actually willing to pay $33.40. They virtually match each other off, and the same occurs on the other side of the scale. So if someone's willing to buy at $33.40, the price will go up. If they are looking to, let's say for example, they're looking to buy $2,793, but the seller here's only got $1,703. If they want to continue to take up the whole parcel to the amount they're looking to purchase, they're going to take some more at $33.41, and that is going to push the price up again. Now, of course, different companies and different properties will have different objectives. So if you're looking at a property, generally speaking, if you're buying a property for growth, you're generally going to be looking at residential property because the yields and the amount of rent that they pay will range somewhere between the 2 to 4% range. Whereas if you're looking for an industrial property, the growth rate on an industrial property like a factory might not be as great, but its dividend yield or the rental return is going to be higher. It could be up towards 10%. Likewise with an Australian company share, if you're looking to purchase a company like BHP or Rio Tinto, they have more of a growth focus, and that comes back to the company objective, and they will look to reinvest the majority of their company earnings back into the future growth of the business. Whereas if you've got a company like Telstra or ANZ, their focus is on paying out a dividend to the investor, so their payout ratio, the amount of profit that they pay back to the investor, is much greater. In terms of income, of course, a property rental will generally pay once a month, whereas a share will pay twice a year. And I think when we talked about the difference in performance, it's important to look at the fact that I guess one of the benefits with investing in a share is that the running costs are rather minimal, as opposed to property investing or residential property investing, when the running costs can be, well, it's not that they're high, but a lot of people don't tend to factor them in when they look at their overall performance. So that's certainly a consideration. But Simon is going to touch on the fact that, well, I'll let him talk about it, but effectively you can get a much greater exposure to a property because a bank's willing to lend more on it, but I'll let Simon touch on that. I'll just close off by going back to our very wise friend Warren Buffett, and he's very well known for some of his famous quotes. You're probably reading them all there already, and they can be applied to shares and property or any kind of asset. First one, I buy on the assumption that they could close the market the next day and not reopen it for 5 years. And that comes back to that concept of long-term investing. Don't get caught up with the short-term noise around markets. Know that you've bought a good property, know that you bought a good share, put it in the top drawer and let it sit there. Be fearful when others are greedy, and be greedy when others are fearful. What he's really saying there is take the emotion out of investing. Invest with your head, not your heart. Because generally speaking, when the market's going up, everyone wants to dive in, and when the market's going down, everyone wants to dive out, no one wants to touch it. But when you identify a good quality asset in the property market or the share market, even when no one else seems to want it, that's a good time to invest. You only find out who is swimming naked when the tide goes out. The GFC was a great example of that. A lot of people were in some really high risk investments. The tide went out and they went broke. Bear Stearns, Lehman Brothers over in the United States. Most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. That really goes back to point number 2. So thank you very much, and I'll allow you to continue.
Thanks, Andrew. So Andrew's talked about the use of property or shares as growth assets to really accumulate wealth. And another way to accumulate wealth and really ramp it up is by borrowing to invest. Borrowing to invest is fantastic because you're essentially using the bank's money to increase your wealth. So the bank's loaning you $50,000, $100,000, you're investing that for a long period of time. At the end of that period, you give the bank back their $50,000 or $100,000 and you get to keep all the growth. So it really magnifies the returns, but it's also important to remember that magnification works in reverse. So if you borrow $100,000 from the bank, use that to invest in shares or perhaps buy a property or whatever the case may be, and the market moves against you, and before you know it, in 4 or 5 years' time, that investment's worth $80,000. Too bad for you. You've still got to pay the bank back their $100,000. So that really goes to why we're investing in growth assets over the longer term, because you need that time frame to really see some positive growth, because as Andrew said, over shorter time frames, the share market and the property market for that matter can be positive or negative. And another advantage to borrowing to invest is that the loan interest is tax deductible, so you can really get some tax concessions as well as the magnified growth if things move your way. I wanted to walk you through an example of how borrowing to invest works. Now, don't get too caught up in the numbers here, but essentially what I'm highlighting is, with a balance of $50,000, if you were to borrow $100,000 from the bank, obviously you're paying the bank back at 7% interest, or $7,000 a year. In this case, earnings at 12%, which is an average for the longer term. You can see after a 10-year period, your $50,000, or your $150,000 for that matter, would be worth about $425,000. And obviously, once you pay the bank back their money, that's $326,000 that you've essentially got in your portfolio. When you started out with 50, and as you can see there, depositing $5,000 a year along the way. The other side of the coin is if you had the $50,000 and didn't borrow to invest. And as you can see, same situation, $5,000 a year, 12%, you've got $253,000. So you can see there's about a $75,000 gain by borrowing the bank's money and using it to your advantage over a long period of time. Now, I mean, the numbers can get a bit confusing there. It's much easier to see on a graph. The red line here essentially shows the growth of $50,000 over 10 years, topping out at $250. Add in that borrowed money, and you can see the blue line well and truly outperforms the red. And as you can see, as each year goes on, the gain gets more and more. So you can really see the value in this graph of borrowing to invest, as I said, over the longer term. Now, borrowing to invest, most people will think, I'm going to borrow money against my house to buy another property, or I might take out a margin loan with the bank to borrow shares. Another form of borrowing that Andrew and I just wanted to make you aware of that not many people know about is called a self-funding instalment, or an SFI. Now, an SFI itself is a financial product, so it's not borrowing to invest through the bank or a margin loan. It's its own financial product, so the borrowing is within the financial product. And essentially what SFIs are used is to borrow to invest in Australian shares. You can't really use them to invest in property. But the advantage of an SFI is that it's a non-recourse loan. Now what that means is that if you had an SFI in BHP, for example, you might have $5,000. You could use that $5,000 to invest in BHP shares, or you could purchase an BHP SFI, and with your $5,000 you're also getting $5,000 of borrowing within that financial product. So in effect, you're getting $10,000 of exposure to BHP through a $5,000 investment. Now, if the market turns against you and BHP halves in value, basically that means that you lose your initial $5,000. The bank won't come calling to you to pay them back their loan, because the way they're designed is that you can't lose any more than what you've put in. They're great for super funds, in particular self-managed super funds, because with a few exceptions, and this being one of them, super funds can't really borrow to invest. So it's a way that you can borrow within your super fund for investment purposes. Why would you want to borrow within your super fund? Because super funds are really for the longer term. Most of the people in the room, you've got your super there. You really can't gain access to that for 30, maybe even 40 years. So it really forces you to take that long-term approach, and you can really get the benefits of borrowing to invest in that leverage, those leverage returns over a long period of time. And the other advantage to an SFI is that the cash flow, where the dividends repay the loan. So often when you're borrowing to invest with the bank, you have to pay them back that 7% interest, or whatever the interest rate may be. The way the SFIs are designed is that over time, as you can see here, you've got your loan balance, and the loan balance will increase on a day-to-day basis as interest accumulates on the loan. But with the SFI over an Australian share, as I said, BHP is an example, they might pay dividends twice a year. So the dividend essentially is used to repay the loan. And that happens again, the loan creeps up and the dividend pays it back. And then over a longer period of time, as you can see, the loan balance is just slowly whittled down. So over a long period, 10 years in this example, you've essentially paid that loan off without really outlaying any of your own personal cash flow, but you've managed to get that double exposure to BHP or whatever the Australian share might be in this case. So yes, SFIs are something to keep in mind. I mean, that about wraps up our talk on budgeting, or laying the foundations and growing wealth. I think we might hand it over